For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
Time to start another one. Wow, is it that time of the week already? Johnny Dean, your podcast host. Actually, everybody's podcast host. Everybody listening to this knows me by now, I think, and you also know the fella here who is down the line from me, Professor Rick Plum, Certified Financial Planner Professional and the Chief Financial Planning Officer for Lucia Capital Group. And you're also not only a Certified Financial Planner Professional, you're an accredited wealth management advisor. I haven't said that. I haven't said that all year. And I saw it on one of your emails, and I saw that AWMA, and I said, oh, yeah, that's right. He does have that. So does everybody know the story behind that? Do we tell people that?
I'm not sure it matters.
It doesn't matter.
The office know it.
It's all right. Well, anyway, we'll get to it sometime. We really should get to the topic at hand. I welcome everybody to the program. Thanks for joining us. We are very happy that you're here as the season progresses along. Even 2025 is progressing along. I mean, we're already
it's going rather quickly.
Everything, the whole thing is going quickly. I just can't. When I was a kid, I had all kinds of time. And now it's just, oh my gosh. But anyway, before we run out of time on this one, we talked on last week's program, Professor Plum, about the tax, managing your taxes in retirement. Are you going to be in a lower tax bracket in retirement? And that came from a question that we had earlier about how is different retirement income tax. And one of the things that came up in that discussion was inheritances. And even though, you may or may not be planning on an inheritance, but if you do get one, it's nice. But there is a tax element to certain inheritances. Now, if you are inheriting a personal stock portfolio, somebody's personal stock portfolio, they have something over at Charles Schwab or wherever it happens to be,
or real estate.
Let's say a primary residence is a good
even
example.
a rental property. A rental property is really nice too because all the depreciation is wiped out as well. Well, for most people.
Yes.
So it's any capital asset that's not in an IRA or anything. Any capital asset I'm receiving, I get a brand new basis as of the day, the value on the date of the individual's passing, from whom I inherited it from. That means that any capital gains that they would have paid, I don't have to.
Yeah, it's a wonderful thing called a step up in basis. And I know I don't want to explain too much about it, but we should mention what we mean when we say that. If let's say my grandfather bought a stock, I'll try to make it easy, for $10 a share, in 1960 or something. And let's say he dies, he'd be old. But
well, let me go back. We have a person that paid $30,000 for Starbucks back in the 90s. They bought quite a bit of stock at the time. It's now worth $12 million.
$12 million from 30,000?
Yeah.
Wow.
I think it was either 30 or 40. So if they sell it during their lifetime, they have to pay, and let's say they sold the whole thing, they would have to pay tax on all the value over that $40,000 purchase price.
Which is about 99% or so of the entire value.
Big gain.
Yeah.
Now, they're not selling it. They're in their late 80s, and they're just holding on to it. And their kids at some point will inherit this, call it $12 million of stock. And from an income tax standpoint, they will start determining their gain or loss as if they had paid for it the day that their dad died.
So if they sell it the day that they inherit it, or the day dad died,
there's no tax because their purchase cost basis is based on the day that the dad, in this case, dies. And so they won't have to pay tax on that $970,000 of gain. That goes away. Same thing happens with real estate. I know people that have paid $150,000, $200,000 for a property, back in the 60s. It's now worth $1 million, $2 million. Plus, it was a condo on the beach, and they depreciated it down to nothing. So their basis is zero. And if if the owners of it sold it, they would have to pay capital gains on all of it plus depreciation recapture. Whereas if I were so lucky to inherit that, I would inherit it to the current $1 million. And if I were to sell it, no tax. But also if I rent it out and turn it into a rental property for me, I get to depreciate it again based on $1 million, not based on their original purchase price. So inheriting personal assets through a trust, something of that nature, where it's not sheltered by an IRA, 401k, retirement plan, annuity, we get a very nice little benefit with this resetting. Now, calling it a step up in basis is a little bit of a misnomer because it's a resetting of the basis. Because if somebody bought a stock in December 2021 and then died in August of 2022, that stock had gone down. Maybe if let's say they just bought the S&P 500, one of the multiple ETFs out there, and they paid $100,000 for it in December of 21, and it's only worth $78,000 in August of 2022, and they die. Well, the person that inherits that gets a new basis based on the date of their death, which means they get a basis of $78,000. They get a resetting of the basis to the date of death. Good or bad? Now, normally it's good because people have held assets for a long time, hopefully. But it doesn't always mean that it's good.
Well, that's a very Professor Plum thing to say, which is true. It is technically, yes, it is a resetting of the basis.
Resetting of the basis.
But we like to say it a step up because more often than not, that's exactly what it is. So inheriting things like that outside of the pre-tax world, we'll say, can be very good. That whole resetting of the basis can work very much in your favor, and I think that's why in some cases you recommend that if parents are going to give a primary residence to their kids or somebody else, that oftentimes the situation warrants, it may be better to let them inherit it rather than you sell it and give them the cash.
Well, it's like the person with the Starbucks stock. It's better for the kids to inherit it than for the parents to sell it.
Yeah, and of course, everybody's situation is different. But, okay, so, and that's fine. Inheriting those kinds of things is good. Inheriting anything, I think, is probably good, even if you have to pay some taxes. So I want to say that right off the bat. But let's talk for a moment, Professor Plum, because it can get confusing. When you start inheriting things like a traditional IRA or 401k, some type of tax-deferred account. Now, I want to mention this because it's the tax-deferred characteristic that can trip some people up. I think either because they didn't know the rules or because they didn't think those rules applied to their situation when they're inheriting it. Whenever you inherit an IRA or 401k, well, I'll let you talk about this, but you'll ultimately be required to take a minimum amount of money out and pay taxes on it. And this is true regardless of the age that you inherit the asset. So talk about that for just a little bit here, Professor Plum. Let's get into this for people who may be inheriting an IRA, or maybe even more directly, somebody who owns an IRA and is going to be giving it to their kids.
Well, at some point, if it's a tax-deferred account, a tax-deferred IRA, 401k, 457, any of the retirement accounts that are out there that are tax-deferred, and Roth is also on the table, but it's a different set of rules. So we'll get into Roth issues in a few minutes. But right now, we're going to talk about the more traditional IRA, 401k, tax-deferred accounts. Somebody, someday, is going to pay taxes on that money, or it's going to become a taxable event to somebody at some point in the future. When is the question? If you're still alive when you're 73, ultimately 75, we talked about that last week, you will have to start taking money out of those tax-deferred accounts, and you will have to pay taxes on it. You'll have to put it on your tax return and then potentially pay taxes at whatever tax rate you're at. If you die and leave it to somebody else, they will potentially have to take money out of that account, out of they'll turn it into what's known as a beneficiary account. And at some point, they're going to have to take the money out of it. When do they have to take the money out? Well, that depends on who the beneficiary is. And there's multiple classes now. There used to only be basically two classes of beneficiary: spouses and non-spouses. Now, I guess a third would be non-people, non-individuals, like charities or some other kind of entity. But we're just going to deal with people right now. It used to be that there was only two, the spouse and the non-spouse. In 2020, they redid the rules. Secure Act redid the rules a little bit, and they put in a new set of rules for people. So if the first thing we need to know is, when did the owner of the IRA pass? If they passed before 2020, they're grandfathered in, they've got the old rules, and they already know what's going on because they've been taking required minimum distributions from that account for quite a while because they've had to.
Yeah.
So from here forward, we're gonna kind of ignore those because those are kind of set in stone. They've been doing it for 5 years or 6 years. They know what's going on, and it's a lifetime stretch capability for those potential beneficiaries. Now, on the other side, what happens if you inherit something from somebody who passes away in 2020 or later? Well, now we've got to go back and look at what category are you in. Are you a spouse? That was the easy one. If you're the surviving spouse, you've got a lot of options. You can roll it into your own IRA. You can leave it alone until the owner would have been required minimum distribution age, and that allows you to take money out without a penalty. Spouses have quite a few options. If it's a non-spouse, now they've created categories in that non-spouse world. And the majority of people that inherit are going to be what they call designated beneficiaries.
Now, I'm sorry to interrupt, but can we, you mentioned the spouse. Can we stay on that for just a moment?
Sure.
Let's start with the spouse inheriting it, because generally I would think, certainly if you're married, when somebody dies, the spouse is going to be the first one to get that. So
generally the spouse is the primary beneficiary.
Yeah. So let's talk about that for a moment. You said that there were some options, and
right,
I know
and
you
it
mentioned
depends on how old the spouse is when they inherit it.
Yes,
I mean, if you've got a very young spouse, maybe unfortunately, somebody I know unfortunately passed away a couple weeks ago at the age of 55, and their spouse is 52. Whether that surviving 52-year-old spouse wants to roll the deceased 401k owners 401k and IRAs into their own name depends on whether or not they want to take any money out of it before 59 and a half. If they need to take money out of that account before 59 and a half, they would leave it in the name of the owner, the deceased person, and that way they can take money out of it without a penalty. Or if they don't need it and they want to just make life easy, they can just roll it over and put it in their own IRA as if it had been theirs from day one. It's now their IRA. So it's not a beneficiary IRA. It's their money.
Yeah. So let's be clear, because you said something very important there. You're using that example where they were relatively young, but if you are a spouse and your spouse passes, the owner of the IRA passes away, and you have a choice where you can take that IRA and roll it into your own name as if you had been the owner from the very beginning, or you can leave it in the deceased spouse's name. And you said that if you leave it in the deceased spouse's name, and in this case they were both under age 59 and a half, which is the age of penalty, the penalty is waived after age 59 and a half. But if they leave it in their spouse's name, but they need the money now, because it is a, what would you call it?
Well, it's a beneficiary IRA at that time. And death is one of those things that gets us away from the 10% penalty for taking what they call premature distributions.
Now, does this spouse...
We're taking it out. The spouse is only 52. We're taking it out of a beneficiary IRA. The 10% penalty is waived because the owner of it's passed away. On the other option, where they take it and put it into their own name, and they're their own IRA, it's their IRA. And they're not 59 and a half. And so if they try to put it into their own IRA and then take money out of it before 59 and a half, it's a 10% penalty, because remember what I said, it's as if they owned it from day one. Can they take money out of their own IRA before 59 and a half without a penalty? Not without an exception. And so this is one of those things we have to look at. Did they do proper planning ahead of time? Do they have the funds to rely on beforehand? Or do we need to take money out of this IRA to live?
Now, in the example that you gave us, sorry about that, but in this example that you gave us with the spouse 52, and I don't know what the other spouse was, 55 or something, or whatever.
The spouse was 54, but yeah.
Oh, okay. But anyway, they're in their early 50s. nobody had a required minimum distribution yet. So the spouse in this case, the surviving spouse, has no issues with any required minimum distributions, correct?
Correct. Now, I did have another client who the spouse was 73-year-old when they died, and the owner was 73-year-old when they died, and the spouse was 57.
Well, that's another situation.
So in that case, if we leave it in the beneficiary name, not the spouse. Okay, the spouse is the beneficiary. If we treat it as a beneficiary IRA, leave it in the owner's name with the spouse as beneficiary, and the owner was 73 years old, they have a required minimum distribution, so the spouse would have to take the owner's required minimum distribution
every year.
On the other hand, if the spouse rolls it over into their own name, then they don't have to deal with the RMDs until the spouse would get to their required minimum distribution age.
Mm-hmm. Okay.
See, it's simple.
There's
and
layer
the
after layer.
The easier part of this.
I know, and there's layer after layer. Well, that's why I wanted to start with the spouse, because this is what's going to happen more frequently. So it really is going to depend on the first thing you need to know on this, Professor Plum, if it's a spouse inheriting it, is what? Their age, both of them, the owner. What's the most important thing?
Well, basically, it's how old was the owner that passed away? How old is the spouse that is inheriting it? Is the spouse under 59 and a half? Will they need any money from these inherited accounts between now and age 59? They're age 59 and a half. And that will direct us to the way to know which way to go.
But other than if the owner is of required minimum distribution age, the surviving spouse in this case won't have to worry about required minimum distribution.
Unless you've got a fairly large difference in age, that doesn't come up. But if you've got, a 15, 20-year difference in age, these situations come up.
Okay. So now that's the spouse part, and let's move along to the non-spouse. So now let's say it's, grandma's or mom's, mom's IRA. And
they leave it to the kids.
So let's kind of take this piece by piece and talk about what people need to know when they're passing it to their kids, and or what the kids need to know when they inherit this pre-tax account from their let's say parents.
Well, and most of the time where we see a non-spouse as the beneficiary, it's going to the kids. I mean, it happens otherwise. I mean, a lot of times it'll go to a sibling. And that's another set of rules. But if it's going to the kids, then and the person passed away after 2019, so 2020 and beyond. We have this new 10-year rule. Now, the 10-year rule is pretty easy to understand. If I inherit an IRA from somebody who dies this year in 2025, I've got 10 years to get all of the money out of that IRA. So by the end of 2035, that beneficiary IRA has got to go. Now, if it's $10,000, it probably won't make it to the end of 2025. But if it's, a couple $100,000, $1 million or more, now the taxes are an issue, and I probably want to stretch it out and do some tax planning. But when it comes to how quickly do I have to take it out, what is my required minimum distribution? First off, when did the person die? They died in 2020 or later. Next question is, how old was that person that died? Were they taking required minimum distributions? Had they reached what the IRS calls their required beginning date? And the required beginning date is April 1st of the year after they reach their required minimum distribution age. So somebody who turned 73 last year, the required beginning date is April 1st of this year. So it's just a matter of looking at, that's the last day that the owner could have taken that first required minimum distribution. Yeah. If the owner has reached, or let's go back to the other, if the owner has not reached their required beginning date, they haven't got their RMDs yet, they die at 65 or something, then the beneficiary has no required minimum distribution in the years 1 through 9 of that 10-year required minimum distribution clock. 100% has to come out in year 10. If they haven't taken anything, then the entire thing comes out in year 10. And this is where planning comes in. Just because you don't have to take any money in years 1 through 9 doesn't mean you shouldn't, to avoid the big tax consequence later on.
So for some people, they will have every year for 10 years a required minimum distribution. For others,
They won't. Now,
others,
people. So we only did half the equation.
Yeah.
For people who have not reached their required beginning date, as I was saying, the beneficiary does not have a required minimum distribution years 1 through 9. However, if the owner had reached, however you want to say it, their required beginning date, if they were basically taking required minimum distributions, then the beneficiary has a required minimum distribution in years 1 through 9. This was the confusing issue that came about with the IRS looking at it and looking at all the different ways that things that have been going on with required minimum distributions over the year, and compared to what the Secure Act actually said in just the way it was written. Congress wrote it to say no RMD 1 through 9, 100% in year 10. That went against a different doctrine that they'd used for years that said that when somebody inherited an IRA, they had to take it out at least as fast as the owner did. So they applied that doctrine to it. They finally got around to finalizing it and making it permanent and law in 2024, but it's retroactive to 2020. Now, if you didn't take any required minimum distributions in 21, 2, 3, 4, they waive those penalties. But going forward, we have those. And so we're picking them up as if we had done them all the way. So, but if you are the beneficiary of an IRA, 401k, or other tax-deferred retirement account from somebody who was required minimum distribution age or older, you do have at least a small required minimum distribution in years 1 through 9 of that 10-year clock. And then whatever you don't take out in years 1 through 9 has got to come out before December 31st of the 10th year.
Yeah.
So going back to the example, if I were to inherit, a great uncle's IRA, and he died this year, my great uncle was 97 years old. I'm making things up because I don't have a great uncle that would leave me this. I would not have a required minimum distribution this year because this is the year that the person died. It's up to them to take their required minimum distribution. My required minimum distribution as a beneficiary would be next year. I would take the age that I'm going to reach next year and look it up on the table 1 from the IRS and say my life expectancy is X. I take last year's balance, divide by X, and I come up with the required minimum distribution I have for year 1. And then year 2, I just take that life expectancy from year 1 and subtract 1, and then do it again from the previous year's balance and all the way until I get to the 10th year, 2035. And then it's really easy because whatever's left in the account in 2035 has got to come out.
Mm-hmm. And this was a hypothetical example that you were throwing out. I just want to remind people of that. So
if you miss the required minimum distribution, the penalty is 25% if the IRS catches you. It's 10% if you catch it and self-correct.
Yeah, and we've said it used to be 50%.
Used to be 50%.
Yeah, not that changed a few years.
Secure Act made it 25-10.
Yeah, and I've heard, don't quote me, but I've heard that if you self-report and you sort of say, if
you have a good reason, you can throw yourself on the mercy of the IRS tax court, and they may waive it.
I had relatives in town.
I ran out of gas.
God, I need to memorize that. Take the Blues Brothers excuses and see what they say.
That's had a flat tire.
That's right. That's not a promise that they'll take it, but it is something. I'm going to write that down one day, Professor Plum, and I'm going to
have it behind me, and I just can't reach it.
Okay, all right. But anyway, so what? And the reason it's important. I mean, if you inherited, as you said, what if you inherited $500,000 from somebody in an IRA and it winds up being taxable? I mean, maybe you don't care about the taxes, but
if you're in the crowd that does not have to take a required minimum distribution year 1 through 9, if you inherit $500,000 today and you leave it alone for 10 years, at 7%, that's going to double. So now you got $1 million. What a shame. But you're going to take it all out and pay taxes on it in 1 year because it has to come out in the 10th year. You probably, just because you don't have to take it all out in the first year, and while you may have a 3 or 4% minimum distribution, you may want to take more. Now, you can't convert it to a Roth, but you can take it out and put it in your personal account and lessen the tax in the future. Maybe how much money can I take out in my tax bracket this year? How much money can I afford to do? And when it comes to what do you do with that inherited IRA, a lot of times we're looking at how do we build this account into the buckets? Which bucket should it go into? Should we leave it alone? And So there's multiple different ways to look at it. Are you subject to the 10-year rule with no RMD in the first 9? Are you subject to the 10-year rule with RMDs in the first 9? Did they pass away long ago? Or are you in the third category of people where, like if my brother, who is not 10 years more older than me, if he were to somehow, and I know it's not going to happen, but it would happen for my sister. If my sister inherits my brother's 401k IRA, and he's not 73 at the time, he's younger than that, she gets to go she doesn't have a 10-year rule.
Okay.
She doesn't fall into the new 10-year rule. She's an eligible designated beneficiary that falls under the old rules, and she can stretch it out for the rest of her life.
An EDB, eligible...
An eligible designated beneficiary, somebody who is less than 10 years younger than the deceased, a non-spouse less than 10 years younger, or a non-spouse that's under the age of 21, or a non-spouse that's disabled or chronically ill, and they get to stretch it out over their lifetime, like we used to be able to do prior to 2020.
Oh, Professor, my head is swimming. You can really go down the tree and start seeing the many branches. I think before the show you said this is kind of like a flow chart.
It's a if-then
scenario, and the farther down you go, the more if-thens there can be. I think for purposes of simplicity, if this is at all possible at this point, but if for purposes of simplicity, you really just need to know, are you a spouse? Then there's one set of ways to go. Are you a surviving spouse, I should say? Or are you a non-spouse beneficiary? And then you have a different set of rules. I think when you keep it at that most basic, as you described it a few minutes ago, it's not that difficult.
Let's keep it into 4 categories. One is the person died before 2019. You're in that category. You know what you're doing. You've been doing it for a while. Keep doing it. The next is the person died in 2020 or later. First question is, are you a spouse? You have the spousal rules to deal with. Not a spouse? Are you an eligible designated beneficiary within 10 years, disabled, under 21? Nope. Or yep or nope. If it's a nope, then you go to, well, then you're a designated beneficiary. You get a 10-year clock. And then we say, okay, was the owner required minimum distribution age or not? And then now you've got your answer. How do you treat the required minimum distribution? 10-year rule with payouts for 1 through 9. 10-year rule, no payouts 1 through 9. Now, these are all for the required minimum distributions from traditional tax-deferred, ultimately taxable accounts. Roths have they have the same rules, just like we were talking about. The spouse has the same rules. The only difference is there's no differential really between an eligible. Well, no, that's not true either. Now we're dealing with the 10-year rule. There's no required minimum distributions on an inherited Roth in years 1 through 9 ever, because the owner didn't have a required minimum distribution. They can't have reached the required beginning age of their Roth required minimum distribution.
One.
So there isn't one. So anybody who inherits a Roth in 2020 or later from somebody that's not a spouse basically is subject to the 10-year rule. And that means if we can afford to do it, that's where if I inherit that $500,000 Roth IRA, I want to leave it alone for 10 years. I don't want to take anything out of it if I can afford to, so that in my hypothetical, previous example, my $500,000 IRA grew to $1 million and created a massive tax problem. The Roth IRA, $500,000 potentially grows to $1 million at 7%. It's all tax free.
It just has to come out of the Roth.
I like that.
It just has to come out of the Roth.
It has to come out of the Roth at the end of the 10 years.
Which is unfortunate, but okay, I'll take it either way.
Yeah, I prefer the Roth, but hey.
Well, this is important stuff, and the reason we bring it up, not to confuse people, and I hope we haven't confused everybody, but we try to keep it as simple as possible. But the reason we bring it up is because the penalty can hit you if you didn't know you had a required minimum distribution, or the big tax bill can hit you if you didn't have a required distribution and yet you didn't wind up. Or you only found out in year 10 that you had to take the entire amount out. It could send you up 2 tax brackets depending Or more, depending
Yeah, it
on how
depends
much.
on how large it is. But all of this is something that you put into your planning. I mentioned it earlier. Where do we use? What bucket do we put that inherited IRA into? In many cases, we're putting it into bucket number one, and we're spending that first. Maybe I'm 62, 63 when I inherit it, and I'm gonna use that as my bucket number one, the money I'm gonna spend first, because that way I can get through the RMDs of the inherited one before I have the RMDs on my own.
Mm-hmm.
And so I don't have to play around with doubling up on different things. On the other hand, if it's a Roth IRA, I may still have it all as bucket number three, because even when it comes out of the Roth IRA in 10 years, it's just going to be invested for long-term growth. That's not a hard and true fast answer for everybody. Everybody's different, and we have to see how it fits into your world.
And that's exactly what Professor Plum does, along with the other advisors there at Lucia Capital Group, who have been doing this kind of thing a long time. Tax planning and tax management, you just don't want to get hit with this. And that's why I said, I think it was on last week's program as well, taxes, other than investor behavior, taxes are the biggest drag on a portfolio. And it's just not, you never get anything out of paying taxes. It's just money that's gone. So
taxes are a drag.
To put it nicely. So that's why we want to bring this up. You need to be aware of these things. We're in the middle of this huge intergenerational wealth transfer, and I don't know how big it is, but as the boomers start to check out, and their kids start to inherit funds, this is what's happening, and it's kind of an important thing. I realize that they can change the rules, and they often do change the rules. Most recently, actually in 2024 when they solidified the rules. But things do change. Just be prepared, and that's what we ask you to do. And the folks at Lucia Capital Group can help you out. Talk to them at Lucia Cap, 800-644-1150. 800-644-1150, the phone number there at Lucia Capital Group. They can help you plan. And as Professor Plum just mentioned a few moments ago, you can work this into your bucket strategy. In fact, you probably should work it into your bucket strategy.
If it's more than you're inheriting a couple $100, you probably want to, account for it appropriately and make the best use of it.
Yeah, you heard how confusing it can be, and unless you're somebody like Professor Plum, it's going to be very hard to understand that. Have an advisor at Lucia Capital Group talk through this with you, walk you through it, and give you your options at least, and you can make your own decision about that. 800-644-1150. Also go online. Find a lot of this stuff at luciacap.com, spelled out LUCIACAP.com. Website, blog posts, videos, white papers, all that stuff at luciacap.com. Want to remind you again as well that you have your guides. You can learn a lot of this stuff. I don't have an ultimate tax guide there yet, but there are plenty of those available. But we have an estate planning guide, we have a bucket strategy guide, retirement income guide, and a Social Security decision kit. Just type whatever you're searching for into the search bar at the top of the website, and it should be the first thing that comes up. You can download it for free, of course. We don't charge for that. And read it and become informed. I really think that kind of stuff is important. Subscribe to this podcast. Go to Apple Podcasts, Spotify. Make sure you hear every single episode and get it downloaded automatically to your device. That way you don't have to worry about it. You just press play, which is the way I think you want to go. Apple Podcasts or Spotify. Professor, we could go on and on. Maybe next time we could talk a little bit more about how the bucket strategy plays into things like this, because you just brought up a really good point about this. Having this income, especially if you have required minimum distributions on an inherited IRA, but you've got your own lurking, in the next 15 years or whatever. It's good to kind of combine those, or at least strategize for them.
Strategize for them. You cannot combine them.
That's why
you cannot combine unless you're the surviving spouse. You cannot combine the inherited IRA with your own IRAs. No. That's a no-no.
No, I didn't mean combine the IRAs. I mean combine your strategy. Put it all into your strategy. No, I know you can't combine them. That's
okay.
That's why.
Just want to make sure.
I'm glad you did, because
words matter.
I tried to correct myself immediately. No, I don't mean combine. I mean strategize for it. It's an important thing to do. Rick, I do thank you so much. Rick, the Professor Plum, certified financial planner professional. As always, I do appreciate you being here. Always a wealth of knowledge. And I was concerned that we wouldn't be able to keep this simple enough, but I think we just reached the edge of that.
It can be complicated, and especially if we're not dealing with a specific situation where we can say, when did they die? How old is the beneficiary? If we can't have concrete numbers, concrete ages, then we're just talking, well, it could be this or it could be that, or that gets wonky real quick. But when you're talking to an individual who's going through this, there's more known facts that can then very straightforward say, okay, you're making a left turn at this branch, you're making a right turn at this branch, and you're ending up at this point. This is the rule you have to follow.
That makes it so much easier. Thank you again, Professor Plum. I do appreciate it. For our buddy, Professor Plum, and everybody at Lucia Capital Group, I'm your podcast host, Johnny Dean. Thanks so much for listening. Managing your financial future. We'll talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including the potential loss of principal. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. Examples cited are hypothetical or for illustrative purposes only, are not guaranteed and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you're required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions and principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. S&P 500 Index is an unmanaged index. It includes a representative sample of large-cap U.S. companies and leading industries. An investment may not be made directly in an index. Before investing, carefully consider an exchange-traded fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Annuities are long-term investment products designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Annuities are not FDIC insured. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC.